on the real estate investing side, like what are you working on there? Look like some small multis along with some vacation homes, that sort of thing. Is that what you got going on?
Yeah, yeah. So the small multis are I'd say my best performing asset. It's funny, I started with the small multis and then I thought I would branch out into the vacation homes, thinking it might be better, and it was actually worse. So I'm sort of exiting that path, but I'm happy to
Okay.
talk about. I mean, I think all of us who do real estate, you try to find something that works, and then you try to improve on it, and sometimes it doesn't, and sometimes it doesn't,
Oh
right? So
yeah.
we ended up going, back toward where we started. I guess we just got lucky on our first one.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
All right, welcome back. I have an awesome guest for you today. Her name is Kate Lynch. She is currently the managing partner at Estate Barrels. So very interesting career. We talk about how she started investment banking, got out and needed to buy some of her time back. She had kids and she wanted to get out of investment banking. It wasn't conducive to her raising her three kids. And so she started investing in real estate, and her path through investing in real estate and how it bought her time back. Now she's working at Estate Barrels. She, again, managing partner, raising capital and deploying that capital into bourbon. So very cool investment strategy and investment thesis. And she has a fund that they raise capital and they deploy it into these barrels. So we talk about that quite a bit. You're going to get a lot out of the episode. I know I did. If you are interested in investing in bourbon, you can definitely reach out to Kate. Her contact information is going to be in the show notes as well. If you would, go on, rate and review. If you leave even just a one-word comment in the podcast review, that helps us a ton. Get awesome guests just like Kate. So let's jump in and talk about some bourbon. Here we go. Hey, Kate, awesome to have you on the show today. Thanks for joining me. I am excited to dive in and talk to you about all things investing, your experience, and just kind of dive in and talk bourbon, essentially. I think that's where we're going to get to. Yeah.
Yeah,
Um,
thanks for inviting me. I love talking about investments, so I'm glad to have a conversation with you.
Fantastic. Just as a way of background, real fast, if you would tell us, I know you were in investment banking. So tell us a little bit about where you got started and then how you transitioned into not only real estate investing, but also where you are now with
Yeah,
Estate Barrels.
I'll try to make it quick. I think probably like a lot of other people who get into a professional job, I had a job that starting out, I absolutely loved. It was exciting. As a Wall Street investment banker, I was working, 80 to 100 hours a week. I was advising the CEOs of banks that were buying other banks or raising, tens or hundreds of millions of dollars of capital. It was a fun job. It was intellectually stimulating, and I thought I would love it forever. Because I was working so hard, I didn't have much of a social life, and I didn't get married until I was almost 40 years old. And we had three kids in the 4 years after we got married. And I very quickly realized that being an investment banker is a lot harder when you have three little kids at home. I had thought I could handle it. I was used to working long hours and not getting a lot of sleep, but it was a lot harder to, I found, be on the road 2 or 3 days a week when I had three babies at home who I wanted to see and they wanted to see me. So like so many other people, I started looking to real estate as an avenue to change my life and gain the financial freedom, the time freedom to be the kind of mom that I wanted to be. I was lucky that I found a path relatively early, I think, through investing in multifamily properties in Cleveland. The market that I live in Cleveland is one where the houses are not that expensive, and we get enough travelers, either business travelers, healthcare travelers, or families visiting their in-laws or what have you. So we get enough visitors to Cleveland that I was able to make those properties Airbnb properties and get a really strong cash flow out of them. Now, to get there, I liquidated my 401k, and I was certainly very nervous about doing that. But I thought to myself, well, your 401k is supposed to be your retirement income. So I'm going to see if I can use it to retire at 45 instead of 65. I was watching every dollar, very focused on getting as much cash flow out of the dollars that I invested in real estate. I was pretty indifferent to appreciation. Not that I wouldn't like to have it, but you can't pay your bills with appreciation, and it doesn't help you be a stay-at-home mom, until you sell, right? So I was able to put pretty much everything that we had in my 401k and even HELOC on our primary home, put all of that into real estate. and create enough cash flow so that I could be a stay-at-home mom. And literally, I quit my job about a year after I bought the first property. We did not yet have the kind of cash flow that could replace the income that I made as an investment banker, but I could see sort of the relationship between how much it cost to buy a house, how much income I was getting, in order to see, okay, I'm going to get there within another year or so. And, when your kids are 2, 4, and 5, one more year of being home with them is more valuable than that one more year of working on the job. So I quit the job thinking, all right, I'm just a stay-at-home mom. I'm going to manage these properties, and I'm done with this finance career that I developed, other than, making sure that I hit the cash flow numbers on our investments. What I found is that once the properties are functioning as an Airbnb, there's not all that much time required to manage them. And my kids are in school during the day. I'm home with them in the summer, but I have sort of 9 o'clock until 3 o'clock every day where I'm able to do something. And so I've had a handful of people reach out to me to ask me to help them with one project or another related to my background in finance. And then along the way, my brother came to me, and he also was retired at that point. He had a much more exciting career path than I had, and sold his company to Visa. So he was in a position where he was, able to look for other opportunities to do something with the money he got from the Visa deal. And one of the things he did was create a bourbon distillery as a passion project. And through that process of owning the distillery over the last 5 years or so, he identified a niche of investing in wholesale barrels of bourbon, and called me about 6 or 8 months ago and just said, this looks really exciting to me. And he said, you're an investment professional. Tell me, is it as good as I think it is? And if so, should we pursue putting together an investment vehicle focused on bourbon? And so I sort of dove back into the work world on terms that are, my own terms, really, right? So it's not like I have a boss or an office that I have to report to. Nobody's keeping track of my hours, but I'm working with my brother, helping him raise money for this bourbon fund. And I just love it. And it's so much more rewarding to be in this position where I really have the flexibility to spend my time where I want. But I realize that intellectual stimulation that I get, as well as, the thrill of the deal that you get from raising capital and working on private equity fund, I still can enjoy that, but I don't have to be on the road 3, 4 days a week to do it.
Yeah, that's fantastic. Thanks for the summary. A lot of questions.
Go for it.
Let's start with the real estate, because that's, aside from all the questions I have about investment banking in general, just to chat with you about that, but we can save that for another show maybe. You said that you traded your appreciation, or your desire for appreciation, for cash flow. So that tells me you were buying a certain type of asset. So can you explain what you were looking for and what you were shopping for?
Yeah, so I think that the more I spend time listening to people who invest in real estate and looking at the markets that other people invest in, it seems like there is a very strong inverse relationship between appreciation and cash flow. Right? The hottest markets, the properties that are on the beachfront, the growth markets, the places where everybody wants to be, they are priced at a level where it's hard to get cash flow.
Yeah.
Right. And so the people who are investing there are doing it because either they want the property for themselves, or because it's incredibly, beautiful on the beach, or they want to ski there, or what have you, right? These are markets that are going to continue to draw investors or buyers, because they're amazing markets. And so the people who invest there are probably going to get really good appreciation, because 10 years from now, it's still going to be awesome to live on the beach, and there's no more beach available. So the number of people who want it will continue to push that price up. The flip side is, if you invest in a market that not a lot of people want, the appreciation rate is really slow. I would say in Cleveland, possibly even negative. And so I say negative because I think that when you buy a property in Cleveland, you usually have to spend money to fix it up, and the after repair value is the same as what you bought it for. So it's a weird market.
Okay.
But what I have found is that this price is still really low relative to the cash flow that you can get, because I just don't have a lot of competition, and there are people traveling here, and I can rent my 2-bedroom, 1-bath place for about $100 a night. I'm renting it for less than what people spend to stay at a hotel. I set all my places up for families like ours, so I always put in a crib and a rocking chair and all the, high chair and family friendly things. A family that has kids can travel here. They can put the kids to bed and then mom and dad can go watch a movie while the kids are sleeping. Like when we travel and we stay at a hotel, my husband and I are like, we're looking at each other in the dark in the hotel room. It's not much fun staying in a hotel room with babies who go to bed at 8 o'clock, and you have to be really quiet so you don't wake them up, and you maybe, tiptoe out to the balcony if you're lucky enough to have one, right? It's such a different scenario. So the properties here, they're so cheap that I can rent them for $100 a night and make money. And it's cheaper for the client, the traveler, than staying at a hotel. And my own point of view, as we've thought about, for example, the potential recession coming and slowing down travel, is my places are still cheaper than a hotel and better than a hotel. So even if there was a slowdown in the economy, I would think that since they cost less than a hotel, there's going to be some people traveling to Cleveland. They'll find those properties, and it should still do well. They rent really consistently. My cash flow definitely fluctuates. We get a lot more money in the summer than we do in January and February when it's freezing cold. But even at $50 a night, that's still $1,500 a month. For a triplex, that's $4,500 a month, and my mortgage is $800 a month. Right?
Yeah.
So $50 a night, I make money, and I probably average around $100 a night for the whole year.
Yeah, that's fantastic. Okay, so let's talk then, because I thought you were going to say C-class property or some kind of, because
no.
Okay, because there is a trade-off. I see what you're saying, though. You're talking about market specifically. You're not going beachfront. You're not going to some Miami or San Francisco market or something.
Yeah, and I've heard other people, like, for example, in a Washington, D.C., they can buy a C property and do really well with it because it's such a ridiculously expensive market. You can still get enough money from the rent on a C property to pay for it. In Cleveland, a C property is pretty hideous. And when we were first looking at houses to buy, we went to see some of those properties that, you can literally find a house for sale in Cleveland for like $40,000. We went to see one where there was an open house scheduled, and my husband and I showed up to go to it. And the agent literally tried to open the front door, and there was a person asleep on the floor. He had to push the person with the door to get the door open. And he was like, come on in. And they knew we were coming. He's like, come on in, just step over this woman and her child. And I was like, yeah, no, I don't think that's the kind of even I'm not going to literally step over people to pursue my investment goals. And for people who are looking in Cleveland, I think you have to see the property yourself. Now, there are also some really beautiful neighborhoods in Cleveland, and I don't invest in the high-end neighborhoods either. I would say, I don't know, you'd probably call it a B+ market, right? It's a nice house in an up-and-coming or a trendy-ish neighborhood, but the kind of place that you'd stay if you're maybe in your first job out of college, not the kind of place that you'd buy if you're a doctor.
Yeah, no, okay. So that makes sense. Isn't it NRP? I think they're headquartered up there, big apartment developer. A buddy of mine moved up there, worked their corporate headquarters. And so, yeah, I'll ask him a little bit more about that, about the market. But clarified on that, I want to know, you started buying these properties. Do you mainly focus on the 3+ unit? Have you gone anywhere like 70 unit, 100 unit, 150 unit?
No,
or are you in that? Okay.
Yeah, it's funny. I have thought about doing that. I don't know that you would get the same interest from Airbnb customers for a big multifamily.
Yeah.
And really, I think that the key to my cash flow is that I'm renting places for about $3,000 a month per floor. Right. So $9,000-ish, probably $8,000, because always the third floor, that rents for less than the first two, because you got to walk up three flights of stairs to get to it. But say call it $8,000 a month. That's really high for Cleveland, right? A long-term rent here is probably around between $1,000 and $1,500 a month for an apartment. And so you wouldn't get, I think, the same return on a big building. Maybe other people can do it, but for me, I think that that's sort of the sweet spot. I do own a duplex. It was next door to a triplex that we owned, so we bought it just for convenience sake. But the profitability on that is about 75% less than the triplex next door, because it has 2 units instead of 3. Yeah. So I think the price relative to the income is, I'm looking for cash flow. These get me there.
Yeah, for sure. Okay. All right. So yeah, that was one question I had. And then, were you putting leverage on these things? Again, you're talking about cash flow. Okay.
Absolutely. Yeah, I take the maximum leverage.
Got it. Okay. All right. So you have focused on the short-term rentals. You don't have long-term rentals, and that's how you're about double of what a long-term rental would for the same type building, is what it sounds like. Yeah. 9,000 compared to about 4,500. So that's solid. So Any particular reason you picked short-term rentals over some other type of investment strategy?
Yeah, when I was looking at real estate, I thought about, all of the things, the commercial real estate, residential, single family, vacation homes, listening to all the podcasts and the books on tape,
Yep.
trying to figure out what works best for us. I think that single family homes or a duplex or triplex, which is just a house that, each floor is a rental, they feel familiar. I think getting into a big multi-story apartment building I hear about other people starting with that. That seems scary to me, in spite of the fact that I worked on Wall Street. I think that it seems like an easy asset class to understand and start with. And then, the Airbnb cash flow is just phenomenal. I don't know if, how long the Airbnb cash flow will stay as strong as it is relative to long-term rents, but for now it's working for us in Cleveland, and we'll stick with it as long as it does, and if it changes, we'll exit. We did try doing vacation homes, so we bought a house down in Hocking Hills, which is sort of a state park area in southern Ohio. If you look at the most income for Airbnb properties, it's actually Logan, Ohio is on the list every year for like some of the top performing properties. It's incredibly popular, but I found that the vacation properties, there's a couple of things that are different about it relative to the multifamilies in Cleveland. One is the guests, when they're going to those, they tend to plan 6 months in advance versus my short-term rentals, they rent a week or two in advance. Secondly, people tend to not vacation for weeks at a time. So you might get a week from some guests, but most of the time it's between 3 and 5 days for the rental time frame. So you have just a lot more vacancy on the vacation homes relative to the urban rentals. And then the third thing is, when people are going on vacation, their expectations are incredibly high around it, right? So in Hocking Hills, a 1-week vacation could cost somebody $5,000, and it's 3 or 4 families together. They've been planning this for 6 months. If something goes wrong, it's like the end of the world. That something silly, like I can't even think about it. Like one guy told me there was a raisin underneath a dresser, and I was like, yeah, no, there's like this much room between the bottom of the dresser and the floor. I don't know what you were doing down there, and I'm really sorry that our cleaners didn't see it, but
Yeah.
I'm not sure how that you can throw it away,
Yeah.
or people will call you and
Is
say,
it tasty? Yeah.
yeah, exactly.
Like,
I'll say, the light bulbs are out in one of the bedrooms. I'm like, come on, like there's a Dollar General literally 1 minute away.
yeah.
You could just get a new light bulb. I mean, yes, we should have our cleaners check every light bulb, but for a 7-bedroom house, they don't necessarily turn on every one. So that sort of angst that people feel around how important this vacation is to them, I find it contributes to just so much more dialogue around complaints and hassles, and do they get a refund if this or that happened? And it's for the relatively worse cash on cash return. I've decided I just like the urban rentals a lot better.
So you had one there, and then have you exited? Did you sell that deal?
It's actually for sale.
Okay.
Yeah, we listed it for sale, and then we actually, because I want to put money into the Bourbon Fund.
Yeah.
We also have a ski house in Holiday Valley that we also listed for sale, and then we have one other one which is in Geneva, Ohio, there's a bunch of wineries there, and that one is a little bit lower key. It's just people going to wineries, so this is not quite the same sort of special vacation feeling that some of our others have. And it has a swimming pool. So it's already the Geneva, Ohio one. We only spent about 300. I think we've spent $320,000 to buy the house, and it is booked up already at this point for most of June, all of July, and half of August. So that one, I think, will have a good cash on cash return, but with a little bit less of that anxiety from the customers around making it the best vacation of the year.
Yeah, it's nice. There are a bunch of wineries close to San Antonio where we are in Fredericksburg, and a lot of people use those, and I know they're killing it up there. So you said something that I guess I don't distinguish between the two, and you clearly are, between short-term rentals and vacation rentals. So short-term rentals, are you doing like nurses, or are you doing people who are staying for a month at a time, or what's typically the length of stay for your guests?
I would say our average is probably around 7 days. We get multi-month rentals in them. They're more urban rentals. So it's people who are either traveling for business, traveling for the hospitals, or traveling to visit family. And it's something where they're just going to visit grandma. It's not a vacation that they planned 6 months ahead. And it's typically just one family. It's not 3 or 4 families together who are planning a trip. So it's much more last minute in terms of when the rentals come in. But it's also just a lower key kind of a thing where people will say, they'll reach out and say, oh, the refrigerator is acting a little funny. Can you have somebody check it out, in the next day or two? It's, you know what I mean? It's just when there is something that goes wrong, and with, right now we have 16 rental units, there's always something going wrong with something. It just seems like the people who are just visiting grandma or in town on a business trip, they're just not all that worried about it, because what they're getting relative to the price feels to them like a real value, versus the people when they spend $5,000 for the vacation, to them, that's, just a really big thing. And they care so much about every aspect of it.
Yeah, no, that makes sense. That makes sense. Okay. So you answered the other question, which was how many units do you have? So you have 16 doors essentially that you guys are working on. Okay. And so that has effectively replaced your income that you had when you were investment banking. So took some time off, I guess. Or you're 9 to 3, right? So I know how that goes. We have kids, exact same schedule. It's 9 to 3. So when, I guess, did you transition into, how long had you been doing the real estate before you started doing the bourbon business?
I retired about a year after I bought the first property.
Yeah.
And it was probably another year after that when my brother reached out about the bourbon opportunity. So, like I said, he was also retired, but looking for businesses to invest in, as opposed to me. I was, just trying to be home with the kids.
Yeah.
And so he invested in a couple different businesses that other people were starting, and he himself founded a craft bourbon distillery. We grew up in the Sandusky, Ohio area, which is where Cedar Point is, a big amusement park touristy area. And as something sort of as a passion project, but also as something to sort of help the community where, he still lives, that we grew up in, he decided to start this distillery there. And anytime a distillery starts, they have about a 4-year window before the product they're making in it can be bottled, because bourbon just has to age over time. And so you sort of have a dilemma of, well, we started this new company and we're not going to have a product for 4 years. And what most of the craft bourbon distilleries do is they buy a wholesale bourbon from some major producers. There's a number of them around the country that produce these barrels for others. And it's something that you probably never think about when you're buying a bottle of bourbon, that it's not necessarily all distilled by the person who bottled it. So even some of the really big companies, they produce some amount of bourbon in-house. And then they supplement the stuff they produce themselves by buying a product that's wholesale from other distilleries that have either more than they need or that produced it specifically to sell to others. And they just blend it together with their specific recipe. And you have no idea if 50% of it, 80% of it, or 0% of it was distilled by the person who bottled it. Really, the bottling is sort of like a branding thing, right? So for my brother's distillery, he bought about 300 barrels to start bottling over the next couple of years. And in 2021, he paid about $600 per barrel. And last year, the brokers that he was working with told him, they asked him, do you want to sell some of those? They're selling for about $3,600. And he was like, I bought these for $600 in 2021 and now I can sell for $3,600. That's incredible. Why did they go up like that? Well, we talked about it, and I, considered, is it just an anomaly? That they went up like any, if you buy a share of stock, somebody tells you, I bought XYZ stock and it tripled over the last year. You'd probably not think, oh, it's probably going to triple this year too, right?
Yeah,
it's just the fact that they got lucky, right? And so my first thought was, did he just get lucky in buying something that went up in value really rapidly? Or is there something that is sustainable in this? And we found it was a combination of both answers, right? So the reality is demand for bourbon has been growing at a double-digit rate over the last 10 years or so. So the price has been going up because there's more and more demand for the product, and also inflation and all the other reasons why prices go up. But the more interesting aspect of it to me is that if you buy new make bourbon when it's first distilled and you hold it for 2 years or 4 years, it's a different product than you started with, right? And so I like to equate it to, if you buy a newborn pig, it costs a lot less than buying a fully grown hog, because the fully grown hog can be turned into bacon and the newborn pig isn't worth, you can't make much bacon out of that. So the difference for the pig it is time, as well as you have to feed it and, house it and care for it. With the bourbon, you just wait. So those barrels, the liquid that goes into them is a clear liquid. It has a very strong smell and a very harsh taste. Over the course of a couple of years, the oak barrels that they sit in flavor it in the same way that a tea bag flavors hot water.
Yeah.
And so it begins to take on a really amazing taste that people want to bottle and drink. So 4-year aged bourbon, by definition, is more valuable than new make bourbon. So today, the price of a new make barrel in Kentucky is around $1,300 per barrel. And the price of a 2-year barrel today is $2,600. So that suggests that if you just buy today and prices don't move at all, you double your money in 2 years. And to me, I've never seen an investment where you can double your money in 2 years if prices don't change.
Yeah.
And
but prices
on
may
top of that,
change up. And
prices have been going up, right? So I think it will be great if prices go up, but our investment thesis is just, we will buy at today's price, hold for 2 years. Even if prices drop by 25% for the 2-year, you make a 20% return over those 2 years. That's incredible downside protection.
Yeah. Okay. So I'm starting to see how you guys have priced this in, and I heard you talking about that on another podcast. And I think you used the calf example. The calf isn't as much as valuable as a full grown cow. So I was like, that's good. This is a great analogy. Okay. So a couple questions. You're telling me that he started with 300 barrels. We're going to get to the pricing and the appreciation. I want to talk about the fund specifically and how that is structured, but I want to go back to kind of how the inception and how you guys got into this thing. So when he bought the barrels, you're saying it was 300 barrel, new make, right?
Yeah.
They call it. Okay. So it was, they already had the bourbon inside. It wasn't just the barrels.
Oh yeah. It's barrels of bourbon. Yeah.
Okay.
Yeah.
Because I know you can sell the cask, right? You can sell those and still make money on those. Is that correct?
People do that. Yes. The bourbon can only be made in a brand new barrel. So Scotch barrels can be used more than once. Scotch is made in barrels that are used over and over again. So again, using the analogy of hot tea, if you were to use the same tea bag over and over again to make your tea, you'd have to soak it longer and longer to get good flavor out of it, right?
Yeah. So
with bourbon, you can only use a brand new barrel to make bourbon. And that's why you only need a couple of years for it to get a strong flavor. Yeah. Whereas a really good Scotch is typically like an 18-year or 25-year Scotch, right?
That makes sense. Okay.
So yes, there is a market for the barrels later, but not for bourbon. People, like, for example, make wine out of, in the barrels that were previously used for bourbon. Yeah. But the barrels that he bought, he was not buying them for investment. He was buying them to bottle the product in his distillery. Mm-hmm. And he did, bottle most of it. But, as part of his role in owning this distillery, he's constantly in touch with the brokers, talking about, what they have for sale and what they're buying. And so as they started saying to him, hey, the demand is just so strong. You had bought some of these barrels, 4 years ago. They know what he owns. And they'd say, would you ever think about selling some of them and giving him prices? And that's what really opened his eyes to the appreciation opportunity in that space. And he did sell some of them just because he thought, why not, take those big gains. And also his distilleries at a point now where they are producing enough of their own bourbon that they have enough to bottle just, their own product. But I think this opportunity was just something that he sort of learned about without expecting to. And then looking back at what the stock market did over the last 3 to 4 years and the amount of, volatility, he called it the roller coaster that, he had sold his company to Visa and had a big chunk of money in the stock market and was like, oh, it's down 20%. Now it's up 20%. And just said, he just was unhappy with that. And so decided to pursue the fund as a way to the bourbon fund as a way to get what we believe will be predictable appreciation over time. If the pricing stays where it is now, then we're talking about 30 or 40% annual rates of return. But even if the pricing of the bourbon barrels was to drop, like I said, by 25%, that's still a 20% annual rate of return. And that feels a lot more interesting to us than having money in the stock market, where any stock you buy, I would argue, is just as likely to be down 10% a year from now as up 10% a year from now. you buy it hoping it's up 10% or up more than 10% a year from now. But Wall Street is so efficient that a small announcement like this, CFO got a DUI, all of a sudden your stock's down 10%, or, there's some bad event that happens in the industry. For these bourbon barrels to not appreciate in value, something really crazy has to happen, because they are aging over time, giving them more intrinsic value that offsets even if the market demand slowed down, the intrinsic appreciation should offset anything that's happening on the market side.
Yeah, that makes sense. And I know from listening to Rick talk about it on the other podcast, he was mentioning how the markets worldwide still aren't completely opened up. And so, yeah, there's a lot of room for growth there. But I want to get into the actual fund itself.
Okay.
Kind of getting to the end here. But so tell me about the fund. I mean, you just mentioned I kind of want to talk about downside risk and some of the risk in general associated with investing in bourbon. But I kind of want to understand for myself, is the fund tied at all to the
distillery?
Yeah, the distillery. Is it?
No.
Okay, so you guys are literally just housing barrels. That is the
That's right.
thesis. Okay, so you're acquiring
not even housing.
Okay.
So it's more like a commodity investment in the sense that there's a wholesale distillery that produces them, and then they actually hold the barrels in their own. It's called a rick house. So everything they produce goes to their rick house. We own it. In some cases, we will be buying barrels of bourbon that they produced and haven't found a buyer for. And in other cases, we will actually contract with them to produce them for us. So if you think about somebody with a big distillery, they don't want to start and stop operations all the time, right? So if they have a period when somebody hasn't hired them or contracted with them to produce bourbon, they're still going to produce it. They just don't have a buyer yet for it. So some of our purchases, for example, Rick already purchased $1 million worth of bourbon for the fund with his own money. And he just, one of the distilleries said, they have some stuff that hasn't sold yet. Here's the price. Do you want it? And it was a really good price. So, he picked up, I don't know how many barrels he got for $1 million, but so he started putting money to work already just because the barrels were available at a good price and he had the money to buy them with. So we'll have a combination of barrels that we contracted with them to produce for us, as well as barrels that we think are attractive. They have to stay. We only are buying Kentucky bourbon because we think that that's the creme de la creme in the market. And he's only buying from between 4 and 7 distilleries that he thinks have the best reputation in the market. So one of the advantages, of course, to this fund, I think, is just he has incredible expertise as a distillery owner, as somebody who has been making bourbon and tasting bourbon, different recipes, and that he knows what are the recipes, because there are a million different types of bourbon recipes. You can play with the numbers in a variety of ways, but there are a small number of bourbon recipes that are extremely common.
Yeah. So
because he knows that, he knows which recipes are most likely to get the best valuation and have the most demand 2 years from now. So we will own that bourbon the same way if you were investing in gold, you would own the gold, but you don't take in most cases, you don't take possession, or if you're investing in oil or some other commodity, right? So that commodity-like aspect of it is really cool, because ultimately we don't touch it. We just own it, and then we will sell it to another buyer. And we are planning to sell at year 2. We've seen that the most rapid appreciation comes between time 0 and year 2. And at that point, the big distilleries, as well as the craft bourbon distilleries, they at that point, they have a sense for how much they want to fill their pipeline, right? Looking 4 years out, they don't necessarily know how much they want to bottle. But when they're within 2 to 3 years, when the bourbon's within 2 to 3 years of age, it starts being acquired by those folks. So we'll sell to those kind of groups, and we're not betting on any particular brand. We're just buying this wholesale product, and then we'll sell it to somebody who wants it, whether it is, as you mentioned, an international buyer. There are international companies that acquire U.S. Kentucky bourbon and bottle it in their own country. Some of them will buy bottled stuff here. And then as well as, we could be selling to any of the craft bourbon distillers. There are hundreds of them, or to one of the major bottlers that just needs to supplement.
Okay. All right. So that cleared that up. I love this. I love just chatting about this and understanding better. Okay. So you guys are housing it. They're housing it there. So you're really kind of, you have it out there. I would liken it to on the real estate side. There are a lot of funds that popped up, PE guys that were going out and just raising capital and deploying that capital into specific operators, right? Okay. Yeah. This operator needs, $5 million chunk. I'm going to slug $5 million into their deal. It'll be in a tick structure, and boom, like that's kind of the setup that some guys were using. And so you guys are betting on the operator, and kind of not in essence, the distiller is the operator.
It's a wholesale. Yeah. I
Yeah.
think it's more of, so we're betting on the demand for bourbon.
Okay.
Without picking a brand.
Yeah.
Right.
But so you're picking the recipes.
Yes.
Yes.
True.
That's what you have to know. I mean, your expertise is coming in not only with the connection, but also with being able to pick the bourbons that you think are going to be
exactly
outperforming the other bourbons.
Who's trustworthy, right? Because there are groups that there are less trustworthy or more trust, as in any industry. Producers of the stuff to have the best quality, and the producers that we have a strong reputation, not some fly by night distillery, as well as which is the recipe that we think is likely to have the best resale value, and then they're also insured, right? So we have insurance on the market value of the bourbon in case of disaster scenario.
I've got a big question mark on my page, like insurance. What happens if one of these things goes up in smoke? Because I've read about it. So you're insured on top of their insurance. Is that what I understand?
We get insurance. So once we own it, if there was a tornado that wiped out the rick house, if it wasn't insured, that's our loss.
For sure.
Right. So we buy insurance for the market value of the product. Right. So if a year from now something happens, it's insured at the value that it would have had at that time, even though we didn't ever sell it. So you still would get appreciation on your insurance. Similar to, I guess, on your house, right? In theory, you could probably insure it for market value versus resale value. Against theft, acts of God, that kind of stuff. You can't insure against a market value loss, but you can insure against it being damaged or destroyed.
All right. So then let's talk, I guess, about how the fund is structured. So again, I'm an agent, a lot of agents listening to this. I'm a real estate investor. I'm making some money. I'm like, hey, I want to put some money into some alternative assets. I just heard Kate talk about bourbon. What kind of returns am I getting if I'm investing some dollars into this bourbon fund?
Yeah. So the bourbon industry overall is booming. And we think that the international market creates a huge opportunity for continued growth in this space. Bourbon is much smaller than Scotch in terms of the market size. And a lot of people, think that in particular the Chinese and Indian markets where people are drinking Scotch right now, once they start being introduced more to bourbon, that they will switch, much as people in the US, there's been a shift toward bourbon from some other products, both because it's a good tasting product and also because it ages more quickly, is less expensive, and has a little bit of the cachet of being the American product, like blue jeans and baseball, right? The problem is that for somebody who wants to get in on the bourbon boom and make money from it, there are not a lot of ways to do that, because there's not a big publicly traded company that only is investing in bourbon. There are a number of spirits companies, but they're in a bunch of industries. So they might have beer and wine and bourbon. So you're not necessarily making money from the bourbon boom by investing in a publicly traded company. Unfortunately, this ridiculous appreciation that has occurred over the last 10 years has created some really terrible online bourbon investment sites that are, I'm shocked at the way they're gouging their customers. When I first started researching this as an industry, one of my first questions to Rick was, isn't somebody else already doing this? And I, just Googled, I want to invest in bourbon, and I'll pop, 5 or 6 different websites where you can invest in bourbon. And the websites will say, the value of bourbon has quadrupled over the last X number of years, and you should invest in it with us. And then I signed up for the websites and read and got, started getting the data. And when I got an email about a specific bourbon that they were trying to sell to investors, the price that they were quoting was like $2,800 a barrel. And I had just, for new make, and I had just talked to Rick about the same product at the time costing $1,200. And I said, what am I missing here? Why are they saying this costs $2,800 and you're saying it costs $1,200? And he said, they're just gouging customers. They're telling these poor investors that they're helping them invest in bourbon. Can you imagine if you're buying a share of stock and your broker doubled the price that he charged you from the market price? And stock prices are transparent. You can look on, Google and find out the price of any stock. Unfortunately, you can't look on Google and find the price of a barrel of bourbon. In particular, you have no idea, what's the mash bill, who's the producer, what state is it in, How many months old is it? So while Rick has every month a broker pricing sheet, much like any fixed income broker would have, that lists out this barrel, this producer, this many months old, this is their mash bill, et cetera. So he's developed a real, knowledge about, how much should a 8-month barrel be valued at relative to an 18-month barrel. Your average retail investor has zero access to that information, and not even investors. Anybody who's not actively buying and selling bourbon, there's no way for them to really get that information. I can't get it other than through Rick. So, if you Google investing in bourbon, you'll find immediately some of those websites. And I'm surprised that it's legal for them to sell investors a product at that much of a markup, but apparently it is, because they're still doing it. And they'll tell investors that you should have a 5 to 8 year timeline, whereas our timeline is we're saying we think you can double your money in 2 years. Rick says he thinks you can get a 20 to 30% return. For myself, I believe that prices will go up. I can't promise that prices will go up, but if prices continue on the trajectory that they've been on, then we should be able to more than double our money over the next 2 years. And that, I think is a 2-year window is so much lower risk than a 5 or 8 year window where you're hoping that, the bourbon boom will still be going on. I hope it will be too, but I don't want to have to depend on that to make a profit.
Yeah, that makes sense. So,
I mean, I do think that there are people literally being taken advantage of it in this space.
Yeah.
And, I worked as an investment banker. It's just wrong.
Yeah. I mean, it's insane to me that you can have a different strike price essentially. So they're building in a profit already at the very beginning of the deal,
and
rather
then
than taking it.
But they still take 20% of the profit.
Sure. Yeah.
It's ridiculous.
I get that, but the profit that they show on paper is lower than it would
otherwise be. Exactly.
Because they've already taken it.
They're very much taking advantage of investors. And I find that it's crazy that happens and people get taken advantage of that way. And yet the bourbon investment is so attractive, right? That we want to, spread the word about it, but in a way that we caution people that you can't just Google investing in bourbon and believe what you see.
Yeah, that makes sense. I was going to ask you then, the information that you were talking about that Rick gets, that only he sees, that it's not available to the public, is that something, if I joined the fund and I'm investing, is that something you guys push through to your investors and say, hey, here's the pricing, this is what it is? I don't know what transparency looks like.
We will tell our investors exactly what we bought at what price from whom. And then we also have been putting out some information where we'll do like a scatter plot, where we'll show them pricing for different ages and different types, but without the names on it, because as you can imagine, the brokers themselves consider that their proprietary information.
Okay.
So for the stuff that we actually buy, we will tell them specifically all the information about those barrels. But for the stuff that's being marketed by the brokers, we can do it without the name of the producer, or just say, for example, we have a chart that shows you Kentucky versus Indiana versus Tennessee by month, what the pricing is, so that they have a sense for, obviously, like I said, we hope that pricing will continue to go up over time, and we want to be able to have our investors continue to see what's going on with pricing, so that they have some confidence during that 2 years of what it looks like returns are going to be, because there will be zero cash flow during the holding time, right?
Yeah,
so
that's why I was asking, because if I'm in and I can see the price points and you guys are relaying that info, that makes me feel more comfortable about my investment, seeing how it's performing over time, even though I'm not getting cash flow.
And also it's, I think you asked about the downside, right? And I think that the biggest risk is that either production just gets way ahead of demand and that pushes prices down, or demand just softens, and that either one of those has the same result, which is the price of the 2-year barrels goes down. Right now, Rick is the biggest investor in the fund, and he started this fund as a way to make more money from his own investments. So in theory, like say 12 months from now, we start seeing prices drop rapidly. We're not just going to hold till year 2 because we said it's a 2-year fund. Rick would say, hey, everybody, prices are dropping fast. We're going to exit now, right? Because that's what he wants to do with his own money. And we'll assume that, I mean, I guess in theory, somebody could say, no, I want to hold. And we could. One of the great things about it is, unlike, for example, real estate, like say you go into a real estate property with a partner and one of you wants to sell and the other doesn't. It's pretty difficult for you to make that happen, right? Either you have to personally buy the person out, you have to go looking for another investor. It's not the case that he can just sell his 50% ownership without affecting you in any way. The cool thing about the bourbon barrels is that they're so commodity-like that if we had a disaster scenario and 50% of the investors wanted to sell and the other 50% didn't, we could just sell half the product and we would be able to return the money to the people who needed it, right? So
Wow.
it's not the plan that we're going for, but yeah, I think
Yeah.
that nature of the business is really, it's just, again, a downside protection that is rare in the investment world.
Yeah. Yeah. That's interesting. I didn't think of that. So it's a positive. And instead of having, so like in a multifamily fund, it's not possible. You got to either replace those investors or you have to sell an asset, and it may not be an opportune time to sell an asset.
And you affect the people who don't want to sell,
Yeah,
right?
exactly.
Whereas in this case, say there's some people think there's going to be prohibition right now, right? And if that comes up, you might say, yeah, I'm pretty sure that's not going to happen. I'll just hold. And somebody else might be like, oh, I need to get out right now. I don't want to risk it. Then we could make that happen without you hurting the other person.
Yeah. Awesome. Okay, Kate, I think we wrap it there. I love talking about bourbon. It's awesome. I want to leave a link so that people can contact you in the show notes.
Okay.
So if anyone is interested in investing in bourbon and you want to learn more about this, please reach out to Kate. She's a wealth of knowledge. She's got a ton of experience on finance and many fronts. So it's been fun chatting with you, and I appreciate you sharing your information. And we will catch you guys on the next episode.
Excellent. It was nice to meet you, and hopefully we have a chance to talk again sometime.
Sounds good.
You know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.